Hello, welcome again to my channel. Today I am Oya Benjamin and this is Xander FST. We provide you with videos and tutorials that help you maximize profit and minimize losses. If you are new to our channel, you are welcome. And to those that are already subscribed, we appreciate you for your trust and for your support. Thank you very much. Liquidity. Liquidity is the bloodline of the market. How? A lot of us don't know. Come with me to this video and I will show you how liquidity runs the market. I urge you to watch to the end for a proper understanding of how liquidity runs the market. Now let's go to the video properly. What is liquidity? Just like I've said, liquidity is the bloodline of the market. Okay? It also refers to that tradable volume made available in the market. This tradable volume makes it easy for the buy and the sell activities to be carried out in the market. In a nutshell, liquidity simply means money invested in the market. That is liquidity. Now, this money invested in the market is what makes the buy and the sell activities run successfully in the market. Now, before we proceed further, I want us to have a quick recap of how the market runs. Okay, now I want you to know that the market runs in two waves. Okay, now we have the impulsive wave, the correctional wave, and the impulsive wave for uptrend. Now in a downtrend we have the impulsive wave, the correctional wave, the impulsive wave. So the market will continue in this cycle until there is a market shift of structure. Now once there is a market shift of structure, there is a break in the pattern. Now the market will now take another pattern in a downward direction. Okay, now let's move. Now for us to understand this concept properly, there are terms that we are going to be looking at, and these terms will help us to understand what liquidity concept is all about. Now let's look at these terms one after the other and see what they mean and how they apply to the market. Liquidity pool. Now what is liquidity pool? Liquidity pool are strategic areas in the market where money is held. Okay, now usually in the form of stop losses or pending orders. In a nutshell, that particular point where a lot of people are interested to either initiate a sell or initiate a buy order from, that particular point becomes a liquidity pool. The liquidity pool always serves as a magnet to the market. The market will always come back to the liquidity pool to draw capitals, okay, to balance itself before continuing every movement. Okay, so I want you to understand that the liquidity pool can be found on the correctional wave of the market, because that is where the inducement takes place. Now let's go further. Now you look at liquidity graph. What is liquidity graph all about? Now liquidity graph is what? A rapid price movement into and out of a liquidity zone, okay, with the main aim of liquidating the stop losses of retail traders. That is liquidity graph. Some will prefer to call it a stop hunt, okay. Some will call it a liquidity sweep. Whether liquidity grab, whether stop hunt, whether liquidity sweep, all of them are talking about the same thing. They're talking about a sharp price movement in and out of a liquidity zone, now with the aim of liquidating invested capital at that zone. Now let's look at it in the chart. You notice that this market has been ranging per se. At this point here, a lot of sellers are willing to enter a sell position, okay, and put their stop loss above here. Now you notice that this price level here becomes a liquidity pool. Now you look at the one here and the down here. I see at this level there are many buy orders that are waiting at this level. So this level here becomes what? A liquidity pool. Now this is what the market does. Okay, and once the market have noticed that there is enough sell orders on this zone, now what happens? A sharp movement above the stop losses of the people. Okay, now and the market came down to its original direction. What did the market do? With this sharp movement, it liquidated all the invested capital in this zone. Does the same thing here. Gave the buyers a sign that yes, they are doing the right thing. Moved up a little bit so that it will convince the buyers that have initiated that they are on the right track. And all of a sudden, you see a sharp movement What is the aim? To liquidate all the funds that is deposited here on the buy side liquidity. You notice that immediately the market succeeded in liquidating all the available sources here, the market continued in its direction. So that is called a liquidity grab. Now let's move on to the next one. Now you look at the buy and the sell side liquidity. Now look at it. Now the buy side liquidity. What is buy side liquidity? Now that position where the stop losses of sellers are placed is called a buy side liquidity. Now let's go to the next one, the sell side liquidity. It represents a level on the chart where the stop losses of buyers, okay, are placed. Now the buy side liquidity is up and the sell side liquidity is down. Take note, okay? So it has to do with stop loss, where stop loss are kept, not the entry itself, but where the stop loss of their entries are kept. Now let's move to the next term. Now the demand and supply zone. What is this thing all about? In a nutshell, a demand zone is that zone that has too much buyers or too much buy orders resting on it. Now a supply zone is that zone that has too much sellers or too much selling orders resting on it. I want you to take note of this. Now the demand and the supply zone are always located on the correctional wave of the market. Now this is the reason. Look at it now. Now this is the major move. Now this is the major move of the market, the impulsive wave. Okay. Now this move is exhausted, and all of a sudden the smart money traders or the big institutions, the market makers, what do? They induce the market, okay, into going in a wrong direction. Now what is their aim? To entice or lure the retail traders that the market has shifted its position, luring them to invest wrongly so that there will be enough capital gathered at the zone for the market to liquidate, to balance itself in order to trigger their buy orders. Now look at it here. You notice at this point here, there was a market structure shift here. There was what? A market structure shift. Once a market structure shift is seen to a smart money trader, it gives him that notion that the direction of the market has changed now from the bullish to what? To the bearish. Okay. Now look at it. There was a market shift here and the market balanced the inefficiency and moved down. Okay. Now, so a retail trader looking at this, we say, wow, there is a market shift and the market has balanced inefficiency, and will begin to enter a sell order. Now there will be much sell order that will be entered at this zone. Okay. Now once the market has gotten enough, now what will happen? The market reversed here. Okay. What is the aim? To liquidate all the money that is invested here. And look at it. Finally, the market swept all the capitals invested here and continued in its move. I want you to know that the correctional wave is where the trap is set, and the impulsive wave is where the distribution of the liquidated capitals are placed. So when you are in a trending market, your aim and goal should be to trade only the impulsive and avoid the correctional. You look at the same thing here, the same thing applies here again. Over and over, it's still the same pattern. Are you there? So the correctional wave, look at it here. You see that this market has been in an up movement, okay, up movement. This happens to be the last low, up movement. Now look at it. All of a sudden, you see a shift. You see a market structure shift. Is it not? Market structure shift. Now you see the market came back here, rebalanced the inefficiency, and continued. You know, giving the retail traders that yes, the market is, there's a change in market structure, so you can start investing yourself. You see, a lot of sell orders will start coming in at this point. What is the aim? A sharp movement to liquidate all these invested capitals. The market sweep, liquidity sweep. All the capitals that are invested here have all been swept off. You see, so this is over and over. Look at it again. Now look at it again. The market continued in the original direction. Okay. Now came down again, another correctional move. This is the last low. Another market shift here, market structure shift. Now having came back, retested it at this point. Are you getting me now? And what are you seeing? Moving up. So what is the aim? To go and liquidate all the capital that are invested here. So when you are trading in the market, avoid the correctional wave. Okay, the correctional wave should give you the idea of where the most orders are resting on. There is something I've noticed. I want you to also look at it here. I noticed that a break of structure introduces a retracement in the market. Now look at it. The liquidity here has been swept. Immediately you see the market reversing. Now it happens both ways. Now this happens to be the demand and the supply. So you can notice that this impulsive wave have swept this particular liquidity. Now immediately it swept this particular liquidity, you see it started moving up. So once the liquidity is swept from up, the market will start coming down. And once the liquidity down is swept, the market will start going up. I believe with this that you have learned something from this video. But before you go, don't forget to hit the subscription button, like this video, share this video to benefit others. Above all, turn on your notification button so that when next I post a video, you will be the first to be notified. Have a successful trading week ahead. Bye.